Welcome everyone to this very special deep dive from the Psychology of Money podcast.
Great to be here.
Go ahead, settle in, get comfortable. Imagine you're just, kicking back in your favorite chair at home.
Yeah, relax with us for a bit.
So today we're getting into something I think, pretty much everyone experiences at some point, especially with money stuff.
Oh, yeah. What's that?
That feeling. You're standing at a crossroads, maybe with your savings, your investments. You absolutely need to make a move. You have to decide something.
Okay, that feeling.
But then nothing. You just freeze up. You've done the research. You've got all the options laid out, maybe too many options. And you just cannot seem to pull the trigger. That feeling, that awful, crippling indecision. It actually has a name.
Analysis paralysis.
Exactly, analysis paralysis. And today we're taking a really deep dive into how this cognitive bias, and it often is subtle, kind of creeps up on you, how it might be silently keeping you from building the wealth you're actually dreaming of.
It's such a common hurdle. And it's fascinating, but also, let's be honest, incredibly frustrating when you're caught in it.
Totally.
So our mission today really is to unpack the behavioral finance concepts behind why we get stuck like this. We'll look at some real-world examples, make it relatable.
Yeah, not just theory.
Not just theory. And most importantly, we want to equip you with some practical, usable strategies to actually break free, to move forward with a bit more confidence.
We want to leave you feeling empowered, right? With actionable insights you can actually use to take control of your financial journey.
That's the goal. Educate, inspire, empower.
Okay, let's do it. Let's jump right in. All right, first section, we're calling this one the invisible wall.
Good name, because that's really how it feels, isn't it? Like this barrier you can't see, but you definitely can't get past.
Exactly. So, analysis paralysis. Let's define it properly. At its core, it's basically an inability to make a decision, right?
Right. And it happens because you're overthinking. Usually when you're faced with just an overwhelming amount of information, data, choices, alternatives.
Brain just sort of short circuits.
It jams up, yeah. And it's really important to understand this isn't about someone just being naturally indecisive.
Yeah.
It's not necessarily a personality trait.
Okay, that's a good point.
It's more like a specific state you get into. The sheer volume of choices and info leads to this endless internal debate, wrangling over every single upside, every potential downside.
Going round and round in circles.
And the end result, you just don't do anything. No action.
Yeah.
And the investment world, oh boy, it's like a breeding ground for this.
Because there's just so much stuff flying at you.
Constantly. News updates, market charts, analyst reports, forecasts, thousands upon thousands of stocks, bonds, funds. Trying to pick the perfect one, it can feel impossible.
So you just don't pick anything.
And that means missed opportunities. Yeah. Real, tangible missed chances for growth, for profit. It's a very real cost.
Okay, let's make this more concrete. Let's talk about someone... let's call her Maya.
Okay.
Maya's, say, in her late 20s. Got a steady job, she's responsible, pays her bills on time, and maybe for the last year she's been reading articles, listening to podcasts, like this one.
Getting educated?
Right. About the power of compound interest. She's seen those charts where a little bit invested early grows into a huge amount later.
The magic of compounding, it's compelling.
It really is. And she gets genuinely excited, inspired. She thinks, okay, I can do this. Just $50 a month. I can start building wealth for retirement. She feels empowered, ready to go.
That's a great starting point. Full of motivation.
So with all this determination, she sits down, goes online. Time to open that first investment account.
Taking action. Good.
The initial steps, no problem. Name, address, link the bank account. Easy stuff. But then she hits that screen.
Yeah, that screen.
Yeah.
We all know that screen.
It's just... a wall of text and numbers, a dizzying list of options, S&P 500 index fund, global technology ETF, emerging markets bond fund, high yield corporate something or other.
Each with its own weird ticker symbol, a different expense ratio you're supposed to compare, a link to a 100-page prospectus full of jargon.
It's overwhelming, and her brain, which was so ready just moments ago, just stalls.
Grinds to a halt.
And this little voice starts whispering in her head.
The voice of doubt.
Yeah. What if I choose the wrong one? What if I put my $50 in the tech fund and then tech crashes, I'll lose it all?
Or what if I choose the safe index fund, but then it goes nowhere for years, I'll miss out?
I need more research. Definitely need more research.
And there it is, the shift. The goal changes from doing something to needing to know more.
And that's the paralysis kicking in, creating that invisible wall. She closes the browser tab.
I'll do it tomorrow. Or later when I have more time.
But tomorrow becomes next week. Next week becomes next month. That initial excitement, it just evaporates.
And it gets replaced by guilt, right?
Yeah.
Maybe even a bit of shame.
Totally. She feels like she's failed somehow. She knows what she should be doing, but she's completely stuck. Can't take that first step.
So her money, her goals, her future, they're all trapped in inaction. And again, it's not about laziness. It's a normal mental defense mechanism, really, but it's working against her in this complex financial world we live in.
It really is. So how can you, listening right now, recognize if this is happening to you? What are the signs?
Well, one of the big ones is just overthinking. Constantly analyzing every tiny detail of a decision, endlessly replaying potential outcomes in your head. What if this happens? But what if that happens?
Creating infinite scenarios.
Exactly. Another key symptom is delaying, putting off the decision, the task, without a really clear reason. It's not just normal procrastination. It often stems from this hidden desire for a perfect outcome, which is almost never possible, especially in finance.
Right? Perfectionism is a killer here.
It is. And a third sign, delegating the decision, just giving up control, handing the choice over to someone else, simply because the number of options feels too huge, too burdensome to deal with yourself. You offload the stress of choosing.
You just want someone else to tell you what to do.
Pretty much. Now, just to frame this, it's interesting to look at the complete opposites of analysis paralysis.
Oh, yeah.
Product managers sometimes use this funny term, utopia myopia.
Utopia myopia.
Yeah, it's like a blissful disregard for the facts. Someone who thinks they know the only right solution, and they completely ignore any research or data that contradicts their perfect vision. They see only their utopia.
So zero analysis, just blind faith in their one idea.
Kind of. And then on the other extreme, maybe even more dangerous, is what some call extinct by instinct.
Extinct by instinct sounds ominous.
It means making really reckless, hasty decisions based purely on gut feeling, with no real data or logic behind it, no thought about consequences, just a quick, maybe emotional reaction.
Wow, so you've got paralysis from too much thought on one end.
And then these extremes of either ignoring facts or acting purely on impulse on the other. It really shows how tricky it is to find that sweet spot, that balanced, informed approach to decision-making.
That leads us perfectly into our next section. We're calling this the paradox of choice, when more becomes less.
Ah, the paradox of choice, yes. This is so central to understanding analysis paralysis, especially today.
It really is a paradox, isn't it? Our modern world, especially the financial world, just bombards us with information, with options, and theoretically that should empower us, make us feel more in control.
That's the theory. But the reality, as the research shows, is often the complete opposite. It can actually make us feel less in control, more overwhelmed.
Why is that?
Well, having too many choices can trigger this deep-seated fear. A fear of choosing poorly, of making the wrong decision. And that fear becomes so strong that, paradoxically, it leads to making no decision at all.
So more options don't necessarily lead to better outcomes or more action.
Quite the opposite. They can significantly harm our ability to actually follow through. The sheer mental effort, the cognitive load of trying to evaluate dozens or hundreds of options, it's exhausting. It can literally paralyze your decision-making process.
I think the most famous example of this has to be the JAM study, right?
Oh, absolutely. The JAM study is a classic, conducted by psychologists Sheena Engar and Mark Lepper, published back in 2000. It's simple, elegant, and perfectly illustrates this paradox.
Can you walk us through it quickly?
Sure. So they set up a tasting booth for gourmet jams in a fancy food store. On one day, they offered a huge selection, 24 different flavors of jam, exotic stuff.
Okay, lots of choice.
Loads of choice. On another day, same setup, but they only offered 6 different flavors, a much smaller selection.
Right.
Now, what they found first was interesting. More people actually stopped at the table with 24 jams. About 60% of passers-by stopped, compared to only 40% for the 6 jam table.
So the bigger variety was more attractive initially. It drew people in.
Exactly. Variety is appealing. But, and this is the crucial part, when they looked at who actually bought jam.
The follow-through.
The follow-through. Only 3% of the people who stopped at the 24 jam table actually ended up buying a jar.
Only 3%. Wow.
Now compare that to the 6 jam table. 30%, 3 neuro of the people who stopped there made a purchase.
30% versus 3%. That's a massive difference.
10 times the conversion rate. It vividly shows how having a wider array of choices, while seemingly good, drastically reduced the likelihood that someone would actually make a decision, a purchase. The abundance of choice led to paralysis.
That's incredible. And it's not just about jam, obviously. This has huge implications for finance.
Huge. Think about 401k plans in the U.S. or similar workplace retirement plans elsewhere. Over the years, the number of investment options offered within these plans has exploded. More funds, more choices.
Yeah.
Supposedly for our benefit.
You'd think more choice is better. Tailor it to your needs.
You'd think. But studies have consistently found the opposite. The proliferation of options has paradoxically reduced participation rates.
Reduced. People are investing less because they have more choices.
Yes. Research shows that for every additional 10 mutual funds offered in a plan, participation actually drops by about 2%.
Wow. That effect is so strong, it can even cancel out the employer match. People are leaving free money on the table.
In some cases, yes. The overwhelm, the decision fatigue caused by too many choices is literally causing people to forego free money from their employer because they can't figure out which funds to pick.
That's just mind-blowing. It shows how powerful this psychological effect is. So what works better then, if more choice isn't the answer?
Well, things like automatic enrollment have been far more effective, where you're opted in by default unless you actively choose to opt out.
Takes the decision burden away initially.
Exactly. And also, carefully choosing the default investment option. For instance, making a diversified, age-appropriate target date fund the default choice. This bypasses the choice overload completely for those who don't want to actively choose. It provides a simple, sensible path forward.
So simplification is key.
Simplicity often wins, especially when dealing with complex decisions like investing. Look at incredibly successful companies like Google or Apple. They are famous for insisting on simplicity, right? Clean interfaces, limited product lines, avoiding confusing arrays of options.
Yeah, they don't offer 50 different iPhone models.
Precisely. Their success reinforces this principle. And it's not just tech. Many financial planners will tell you that a major reason clients come to them is specifically to simplify their financial lives. They're drowning in complexity and paralysis, and they just want someone to help them cut through the noise.
They're paying for simplification and clarity.
That's a huge part of the value. It shows how deeply this paradox of choice affects us, driving us to seek simplicity even amidst abundance.
Okay, so we've got analysis paralysis, we've got the paradox of choice. Now let's really put on our behavioral finance goggles and dig into the why. Why do our brains work this way with money?
Yes, this is where behavioral finance becomes so insightful. It essentially bridges the gap between, let's say, traditional economic theory and how real humans actually behave with their money.
What's the traditional view?
Traditional or standard finance is built on this idea of perfect rationality. It assumes we're all like Mr. Spock, basically, a perfectly logical homo economicus, someone who's always fully informed, has perfect knowledge, and makes decisions purely based on maximizing their economic benefit.
Which sounds nice, but not very realistic.
Not very realistic at all. Standard finance doesn't really ask why investors make certain choices, it just assumes rationality. Behavioral finance, on the other hand, starts with a more grounded premise. Bounded rationality.
Bounded rationale.
Yeah, a concept introduced by Nobel laureate Herbert Simon way back in 1955. It assumes we're normal investors, Homo sapiens, not economicus. We're not perfectly informed, we don't have perfect knowledge, and crucially, our decisions are heavily influenced by psychology, by emotions, by cognitive biases.
By being human.
By being human. And understanding these human factors is absolutely critical if we want to understand why markets fluctuate the way they do and why we, as individuals, often make costly investment mistakes that standard finance just can't explain.
So it's about both our thinking processes and our feelings getting involved. You mentioned cognitive versus emotional biases earlier.
Exactly. Behavioral biases cover both. Cognitive biases are basically errors in our thinking and how we process information. They're like bugs in our mental software shortcuts that go wrong, myth-interpretations of data. Emotional biases stem from our feelings, fear, greed, regret, hope, excitement that arise during that decision-making process.
And which ones are harder to deal with?
Generally, emotional biases are considered harder to correct or eliminate because they're often deeply ingrained gut-level reactions. Cognitive errors, once you understand them, can sometimes be mitigated with logic and structured thinking. But both types work together, influencing our decisions in different ways and leading to behaviors that can really hold back our wealth building.
And in today's world, does all the information available online help or hurt?
That's the tricky part. The sheer abundance of online information, while it seems like it should help, can actually exacerbate these biases. It can create this dangerous illusion of comprehensive understanding.
The illusion of understanding, meaning we think we know more than we do.
Precisely. You spend hours Googling stocks, reading forums, watching YouTube videos, and you start to feel like an expert. You might genuinely believe you can outperform the market or professional managers through your own research and active trading.
But the evidence doesn't really back that up for most people, does it?
Generally, no. We mentioned earlier, for example, that in 2023, only about a quarter of active fund managers had beaten the market over the previous decade. If the pros struggle, it's a tall order for individual investors relying solely on online research.
So the challenge isn't just the amount of information.
It's also the quality, the relevance, the noise-to-signal ratio, especially with social media and the 24/7 news cycle, trying to figure out what actually matters, what's truly significant versus what's just noise. It's incredibly difficult. And that difficulty itself can fuel paralysis, making you feel even more overwhelmed and less capable of making a sound decision. It becomes an endless quest for more data, feeding the paralysis loop.
Okay, let's get specific now. Let's talk about these silent saboteurs, the key cognitive biases that are quietly undermining our financial success, often without us even noticing.
These are the hidden psychological forces really messing with our money decisions.
Let's start with a really big one, something I think affects almost everyone: loss aversion.
Ah, yes. Loss aversion. Foundational concept in behavioral finance. It's our tendency to feel the pain of a loss much more intensely than we feel the pleasure of an equivalent gain.
So losing $100 feels way worse than gaining $100 feels good.
Exactly. The research, like the classic work by Tversky and Kahneman, suggests that the negative feeling from a loss can be twice, maybe even 2.5 times, as powerful as the positive feeling from an equal gain.
Wow, 2 to 2.5 times stronger.
Think about that imbalance. A 1% drop in your portfolio might trigger the same amount of emotional distress as needing a 2% or 2.5% gain to feel equally good.
Oh, okay. I can see how that would affect decisions. What's the consequence?
The big consequence is that people tend to hold on to losing investments for far too long, way past the point where it's rational. They're desperately hoping it will just recover, just get back to break even, so they don't have to realize the loss to feel that pain.
Even if that money could be doing better somewhere else.
Precisely. It prevents them from cutting their losses and reallocating that capital to potentially better opportunities. Closely related is risk aversion. This isn't quite the same, but it's the general tendency to be more concerned about avoiding losses than making gains.
Leading to maybe being too conservative.
Exactly. It can lead to overly cautious investment strategies, sticking to cash or low-yield bonds, or simply missing out on investment opportunities altogether because the fear of potential loss outweighs the prospect of potential gain. This is all explained beautifully by prospect theory, which says we evaluate gains and losses relative to a reference point, often what we paid for something or our current situation, and our emotional response is much steeper on the loss side. Interestingly, it also suggests we become risk-seeking when trying to recover from a loss, like doubling down to break even, but risk-averse when considering a gain, preferring a sure small win over a chance at a bigger one.
Our brains are wired to avoid pain, even if it costs us in the long run.
Okay, what's next? Another big one seems to be overconfidence and overoptimism. Oh, absolutely huge. Overconfidence is when we systematically overestimate our own knowledge, our abilities, or the accuracy of our beliefs. And this often leads directly to being overoptimistic about future outcomes.
And there are different flavors of this overconfidence.
Yeah, researchers break it down into 3 main types. First is overestimation. Basically thinking you're better, smarter, or more in control than you actually are, or inflating your chances of success.
Like thinking you're an above-average driver.
Classic example. That's actually the second type, overplacement, also known as the better-than-average effect.
Yeah.
Most people rate themselves as better than average on desirable traits, which is statistically impossible.
Right.
And the third type is overprecision, being excessively certain about the accuracy of your own beliefs or predictions. You're too sure you're right, which leads you to underestimate the actual risks involved.
And over-optimism is just generally expecting things to turn out better than they realistically might.
Pretty much. Unrealistically rosy predictions about the future, often made without really considering all the potential downsides or relevant information. And the consequences for investors, they're significant.
Like trading too much.
Exactly. Overconfidence often leads to excessive trading. That famous study showed men traded 45% more than women, likely due to higher confidence, and this extra trading actually reduced their net returns because of transaction costs.
So thinking you're smarter actually made you poorer.
In many cases, yes. It can also lead to poorly diversified portfolios. You're so sure you've picked the winners that you don't spread your risk. Interestingly, studies also suggest that wealthier and more powerful individuals tend to exhibit more overconfidence.
That's interesting. You'd think success might temper it.
Not always. Think of overconfident CEOs pouring money into their own company's stock, taking huge risks. And crucially, overconfidence, especially when combined with hindsight bias, makes it really hard to learn from your mistakes. You just keep thinking you are right all along, or that you'll get it right next time.
Okay, let's talk about group behavior. Herd mentality. That seems really relevant today with social media and everything.
Absolutely. Herd mentality is making decisions based primarily on what the group is doing rather than on your own independent analysis or judgment. You see everyone else piling into something, so you do too.
Driven by that fear of missing out, FOMO.
FOMO is a huge driver here. That anxiety that others are experiencing something rewarding that you're not a part of. In investing, this fear can lead people to jump into hot stocks or trends without doing any real due diligence, skipping the fundamental analysis just because everyone else is doing it and they don't want to be left behind.
And this can influence a lot of people.
Research suggests it doesn't take much. Sometimes as few as 5% of informed or early moving investors can influence the decisions of the other 95%. It's a powerful social contagion effect.
Leading to bubbles.
It's a major contributor to market bubbles, where asset prices get inflated way beyond their intrinsic value simply because of herd behavior. And on the flip side, it fuels panic selling. When the herd starts selling, everyone rushes for the exit, often without considering their own long-term goals or whether the selling is justified.
And FOMO isn't just about investing, is it? It hits our everyday spending, too.
Oh, massively. That desire to keep up, to participate in experiences or buy things because your peers are, or because you see it constantly online, it leads directly to overspending.
That trip you can't afford, the new gadget you don't need.
Exactly. You feel that anxiety, that restlessness about missing out, and it pushes you into impulsive financial decisions. Impulse buys, overly risky get-rich-quick schemes because you fear missing the boat, overspending on social events. It can even make you vulnerable to scams promising easy money.
And it pulls focus away from the important stuff.
Definitely. It often leads to neglecting long-term savings, retirement planning, debt reduction, all in favor of that immediate gratification driven by social comparison and social media. It pours gasoline on the FOMO fire with its curated feeds showing only the highlights, making you feel like you're constantly falling short.
Okay, what about biases related to memory and stereotypes, like availability bias?
Right, the availability heuristic or recall bias. This means we make decisions based on information that's most easily recalled from memory, the most vivid or recent stuff. But that easily recalled info isn't necessarily the most accurate or representative of the whole picture.
Like the plane crash example.
Perfect example. People overestimate the risk of flying and underestimate the risk of driving because plane crashes are rare, but highly publicized and very memorable. Car accidents are common, but less sensational. So, the availability of the dramatic memory biases are risk perception.
And in investing.
We tend to chase past performance, investing in funds or stocks that have done really well recently because their success is top of mind. It's easily recalled, even though we all know the disclaimer. Past performance is not indicative of future results. We overweight the recent, easily available data.
And representativeness bias, how is that different?
Representativeness is about making judgments based on stereotypes or analogies. How closely does a situation match a mental prototype we have? We often overemphasize how similar something seems to a category we know, ignoring broader statistical facts or base rates.
Like assuming a good company must be a good stock.
Classic example. We might assume a well-known, respected blue-chip company is automatically a great investment, expecting high returns simply because it fits our stereotype of a good company. But the quality of the business and the quality of the stock as an investment are two different things. This misaligns perceived risk with actual risk.
There was that famous Linda problem too, wasn't there?
Yes, the conjunction fallacy. People were told Linda is outspoken, bright, and concerned with social justice. Then asked if it's more likely she's a bank teller or a bank teller and active in the feminist movement. Most people choose the second option because it seems more representative of the description. But logically, the probability of two things being true, teller and the activist, must be lower than the probability of just one thing being true, teller. Our desire for a representative story overrides basic probability. This bias also leads us to over-rely on small sample sizes, drawing big conclusions from very limited evidence because it seems representative.
Okay, then there's this group. Conservatism, status quo, and anchoring bias. These seem related to sticking with what we know or what we first heard.
They are definitely related, all contributing to inertia. Conservatism bias is our resistance to change, our tendency to cling to prior beliefs or forecasts, even when new information comes along. We underreact to new data initially. People get used to how things are and avoid change because it feels risky or uncomfortable.
Like holding onto inherited stock just because it's always been there.
Exactly. Even if it's performing poorly, the sheer history, the familiarity, makes it hard to sell. Interestingly, while conservatism causes underreaction initially, if a trend persists long enough, people can then swing to overreaction.
And status quo bias is just preferring things to stay the same.
Pretty much. It plays a huge role in analysis paralysis itself. We actively avoid choices that might disrupt our current situation, our comfort zone. Doing nothing often feels easier and safer than doing something that involves change, even if that change could be positive. Inertia wins.
And anchoring. That's about getting stuck on the first piece of information.
Yes, we rely too heavily on the first piece of data we receive, the anchor, when making decisions. And we're reluctant to adjust away from that anchor, even when new, contradictory information comes to light.
Like negotiating a price. The first number thrown out often anchors the whole negotiation.
Classic example. Or that GDP estimate for Serbia, the initial question anchors your subsequent guess. The consequence is that we often ignore or downplay new information because we're mentally tethered to that initial anchor, leading to poor judgments.
What about mental accounting? You mentioned this earlier. Treating money differently depending on where it came from or where it's going.
It's fascinating, isn't it? We mentally put money into different buckets or accounts like salary, bonus, vacation fund, emergency fund, and we treat the money in each bucket differently, even though logically, a dollar is a dollar.
It violates that idea of fungibility.
Completely. That example of the family budgeting. They might be frugal with their food budget money at home, but then splurge on an expensive meal using their entertainment budget money. The source or intended use of the money changes its perceived value and how willing we are to spend it.
And this can lead to weird decisions.
Definitely. It's driven by how the decision is framed. Someone might take big risks with their windfall money from a bonus or inheritance, treating it like house money, while being extremely conservative with their hard-earned salary savings. Or, after a loss in one specific mental account, say a speculative stock investment, they might take more risk specifically in that account to try and win it back, rather than looking at their overall financial picture rationally.
And the sunk cost fallacy is related here too, getting stuck because of past investments.
Exactly. It's a specific type of framing effect. We make decisions about a current situation based on what we've already invested. Time, money, effort, even though that investment is gone, sunk, and cannot be recovered.
Like staying in a bad movie because you already paid for the ticket and watched half of it.
Perfect example. Or refusing to drop a class you're failing because you've put so much work into it already, even though dropping it might be the rational choice for your overall GPA. That past investment shouldn't influence the future decision, but it so often does. We hate feeling like we wasted something.
Then there's confirmation bias, seeking out information that just confirms what we already believe.
A huge one, especially online. We tend to actively look for facts and opinions that support our existing conclusions, our hunches, our worldview, and we conveniently ignore, dismiss, or downplay evidence that contradicts our beliefs. We even interpret ambiguous information in a way that fits our narrative.
Creating an echo chamber.
Precisely. And this directly fuels overconfidence because everything you read seems to agree with you. Financial analysts, for instance, might stick to their initial forecasts even when earnings news suggests they should change because they discount the contradictory information. This bias is a major roadblock to learning and adapting because it prevents us from genuinely challenging our own hypotheses.
And what about looking back? Hindsight bias, the I knew it all along effect.
Right. After something happens, we tend to believe we predicted it or expected it all along, even if we didn't. It distorts our memory of what we actually thought before the event.
Making us think we're better predictors than we are.
Exactly. It gives investors this false sense of security, this illusion of competence. It prevents genuine learning from mistakes because you rewrite history in your mind. Oh, I knew that stock was going to tank, you might think, conveniently forgetting your earlier enthusiasm.
And this reinforces overconfidence again.
Massively,
Yeah.
which can lead to taking excessive risks in the future because you think you've got it figured out. Behavioral experts often point to hindsight bias and overconfidence as key reasons why people keep trying active trading strategies, despite the evidence against their long-term success for most individuals.
There are so many of these. Briefly, what about optimism bias? Different from over-optimism.
Slightly different, but related. Optimism bias is a general tendency to overestimate the likelihood of positive things happening to us and underestimate the likelihood of negative things. We think we're less likely than others to get sick, have an accident, or perhaps pick losing stocks.
Affecting our risk perception again.
Yes, it can alter how we perceive risks and make decisions, particularly in finance and health. We tend to maintain these rosy expectations by discounting undesirable information that challenges our optimism.
Wow. Okay, there are even more, right? Like choice supportive bias. Remembering our choices as better than they were.
Yep, distorting memories to make the options we picked seem more attractive than the ones we rejected. Recency primacy bias, giving more weight to the latest info or the first info we heard. Repetition bias, believing something just because we've heard it many times.
Underestimating uncertainty, the illusion of control.
Thinking we have more influence over random events than we do. Framing bias, how information is presented. Gains versus losses, percentages versus absolute numbers, drastically affects our choices. That's central to prospect theory too.
Cognitive dissonance, that uncomfortable feeling when our beliefs clash with our actions or new information.
Exactly. Like the black swan idea, discovering something that shatters a strongly held belief creates mental discomfort we try to resolve, sometimes irrationally.
And the winner's curse. Paying too much in options or acquisitions.
Right. The winning bid often exceeds the true value because the competition gets so heated. The winner wins, but has overpaid.
Yeah.
It's a Pyrrhic victory, often because the other bidders dropped out knowing the price was too high. All these biases, working together or individually, are these silent saboteurs constantly influencing our financial judgment.
Okay, this is where it gets really sobering. All these mental quirks, the overthinking, the biases, the paralysis, they aren't just interesting psychological concepts. They have real, tangible, often very significant costs that directly impact our ability to build wealth.
This is the bottom line, isn't it? The real-world consequences.
So let's circle back to Maya. That one year, she delayed investing just $50 a month because she was paralyzed by choice. What does that actually cost her?
Well, compounded over 30 or 40 years until retirement. That single year of inaction, even as a small amount like $50 a month, can easily cost her tens of thousands of dollars in potential future wealth. Tens of thousands lost just from delaying that first step.
That really puts it in perspective. The biggest risk wasn't picking the wrong fund.
The biggest risk was making no move at all. The opportunity cost of inaction, fueled by analysis paralysis, is immense over the long term.
And this isn't just an individual story like Maya's. On a broader scale, individual investors often don't do as well as they could, right?
That's consistently shown in the data. Individual investors, on average, tend to underperform a simple, passive buy-and-hold strategy, like just buying a low-cost ETF that tracks the entire market.
And why is that? What's the main reason for this underperformance?
A huge factor is transaction costs. All that active trading, the buying and selling driven by overconfidence, FOMO, trying to time the market. It consistently fails to beat passive approaches, mainly because the fees add up. Commissions, bid-ask spreads, taxes, they steadily eat away at your net returns.
Every trade has a cost.
Every trade. Remember that study from Taiwan we mentioned? Retail investors there underperformed by about 3.8% per year on average. Their collective losses from this underperformance amounted to over 2% of the entire country's GDP.
Wow. That's staggering. And it's not just costs, it's also about skill and timing.
Yes. Most individual investors simply lack the aptitude, or frankly, the luck required to consistently time the market correctly, knowing when to get in and when to get out. And they often struggle to select individual investments that will consistently outperform over time. While some studies show tiny, short-term wins around specific events, like earnings announcements, these are usually small, hard to repeat, and quickly eroded by those transaction costs, or often followed by longer periods of underperformance.
Okay, let's talk about another costly behavior, the disposition effect. That tendency to sell winners too soon and hold losers too long.
Yes. Sell winners, hold losers. It's deeply ingrained. We lock in the pleasure of a gain quickly, but we avoid the pain of realizing a loss at almost all costs.
That study by Odin really showed this, didn't it?
It did. He looked at thousands of discount brokerage accounts and found investors were 50% more likely to sell a stock that had gone up compared to selling a stock that had gone down relative to the opportunities they had.
So we actively choose to realize gains, but procrastinate on realizing losses.
Exactly. And this behavior gets worse when the market is rising. Everyone wants to lock in profits. It happens even with professional managers, although usually to a lesser extent. It's a classic example of our emotions. The desire for pleasure, the aversion to pain overriding rational financial strategy.
And then there's the sin of under-diversification, not spreading your risk enough.
Right. Basic finance tells us diversification is key to managing risk, spreading your investments across different assets, sectors, geographies. But what do individual investors actually do?
They often don't diversify much, do they?
Evidence shows they often hold very few securities. That Barber and Odin study found the average investor held only about 4 stocks, and often without much thought given to how correlated those stocks might be. If all 4 are in the same industry, you're not diversified at all.
Just concentrating your risk. What about that naive diversification you mentioned? The 1N rule.
Yeah, that's a common shortcut when faced with too many choices, like in a 401k. Instead of analyzing, people just split their money equally among all the available options, 1/nth in each.
Which sounds fair, but can lead to weird results.
It can totally skew your allocation. If you're offered 1 bond fund and 9 stock funds, and you split your money 10% in each, you end up with 90% in stocks. That might be far riskier than you intended. It's a result of decision paralysis. Just spread it evenly rather than optimal allocation.
And related to this is home bias, right? Sticking to investments in your own country or region.
Yes, a very prevalent bias. People tend to overweight investments from their home country or even local companies they feel familiar with. But from a diversification standpoint, this is usually flawed. Global diversification is generally better because markets in different countries don't always move in perfect sync.
It's that illusion of knowledge again, thinking, local companies better.
Often, yes. Familiarity gets mistaken for actual insight or a safety advantage, but it just leads to concentrating your risk geographically. And the most dangerous form of this, as we discussed, is being heavily invested in your employer's stock.
Like the Enron situation.
The tragic example. Employees lost their jobs, their healthcare, and their retirement savings all tied up in one company's fate. It's the ultimate concentration of risk. All these behaviors, excessive trading, holding losers, under-diversifying home bias, they aren't just theoretical mistakes. They have very real, often devastating, tangible costs that directly prevent people from achieving their financial goals.
Okay, we've seen the problem, we understand the psychology, we know the costs. Now let's get practical. This is the empowering part, breaking free. What concrete strategies can people use to overcome analysis paralysis and fight back against these biases?
This is where we turn understanding into action. The first big area is bringing more structure to your decision-making process.
Structure helps combat the chaos of too much information.
Exactly. One simple but powerful technique. Set deadlines. Give yourself a specific time frame to make a decision. I will choose my investment allocation by Friday. It creates urgency and prevents endless procrastination.
Even if it feels a bit forced, it works.
It often does. Another key strategy, echoing the JAM study, consciously eliminate options and reduce your information pool. Don't try to analyze everything. Identify your core priorities, screen out options that don't meet them, and focus your analysis on a much smaller, manageable set.
Don't boil the ocean. Choose from 3 funds, not 3,000.
Precisely. And cultivate a healthier relationship with mistakes. Accept that decisions won't be perfect, and focus on learning from failures. Especially in investing, outcomes are influenced by factors beyond your control. Don't let the fear of imperfection paralyze you. Learn, adapt, and move on. Be kind to yourself in this process.
I really like this next one for breaking inertia. Start with small steps. Maybe use dollar-cost averaging, DCA.
Yes. If you're stuck deciding when to invest a lump sum or which exact fund is best, just commit to investing a smaller fixed amount regularly over time. $50 a month, $100 a week, whatever fits.
Even if it's not mathematically always the absolute optimal way compared to investing a lump sum right away.
Right. Lump sum investing often wins out purely on math over the long term, assuming markets trend upwards. But for someone frozen by paralysis, DCA is psychologically brilliant. It gets you in the game. It overcomes the inaction. And as we said, investing something is almost always better than staying in cash long term. The peace of mind and the benefit of simply starting can easily outweigh any tiny potential difference in returns.
It's about progress, not perfection. What about the pre-mortem exercise? That sounds intriguing.
It's a great tool against overconfidence. Before you commit to a strategy, imagine it's 10 or 15 years in the future and your plan has completely failed. Utter disaster. Now ask yourself, why did it fail? What went wrong?
You're stress testing it mentally beforehand.
Exactly. It forces you to think critically about potential pitfalls, flawed assumptions, and external risks in a rational way before you're emotionally invested. It helps you build a more robust plan.
How do we fight confirmation bias and herd mentality? How do we avoid just following the crowd or seeking out only what we want to hear?
By actively seeking contrary viewpoints and challenging your own assumptions. Make it a deliberate practice. Read articles or analysts who disagree with your thesis. Ask yourself, what if the opposite is true? Challenge the historical trends everyone takes for granted. Conduct research that specifically looks for the bear case, the arguments against your idea. Ask open-ended questions, not just questions seeking confirmation.
Get outside your own echo chamber.
You have to. And another simple, practical tip, regularly review your investment performance against objective benchmarks. Don't just look at your own statement and feel good or bad. Compare your returns to a relevant index, like the S&P 500, or a balanced fund benchmark. It provides a dose of reality and helps keep biases like overconfidence in check.
Okay, so structured thinking is key. What about getting help from others? Leveraging external expertise.
Hugely important. Collaborating with or seeking input from a trusted financial advisor, or even just a financially savvy, level-headed friend, can be invaluable. They provide an external perspective, challenge your thinking, and can help you develop personalized strategies to manage your specific biases.
And if you do seek professional help, you mentioned looking for a specific kind of advisor.
Yes, strongly consider a fee-based fiduciary advisor. Fiduciary means they are legally obligated to act in your best interest. Fee-based, or fee-only, means their compensation is transparent and not primarily based on selling you specific products via commissions. This alignment is crucial for trust.
They're like that financial physician you mentioned earlier.
Exactly. A good advisor helps you regain perspective, clarifies goals, sets strategies, and importantly, acts as a behavioral coach, helping you navigate the psychological pitfalls along the way.
Is there a specific framework advisors might use that incorporates this behavioral side?
Yes, a more integrated approach gaining traction is behavioral goals-based wealth management. BGBWM. It combines behavioral insights directly with financial planning based on your life goals.
How does that work?
It starts by categorizing your goals' essential needs, like basic retirement living, lifestyle wants, travel, hobbies, and maybe legacy aspirations, charity, inheritance. Each goal category can then be funded with investments matched to its importance and time horizon using different risk levels.
So risk isn't just one number, it's tied to specific goals.
Right. Risk is framed as the danger of not achieving a specific goal. It also explicitly acknowledges mental accounting that you might have different risk tolerances for your needs money versus your wants money. It builds a portfolio structure that aligns with how you naturally think about money, making it easier to stick with the plan and mitigating biases like loss aversion for critical goals.
And advisors use questionnaires to figure out this risk profile.
Yes, risk profiling questionnaires are important, but they need to be nuanced. They should ideally probe your risk tolerance for different goals or mental accounts. They also need to recognize that your tolerance can shift with market moods. You feel braver in a bull market, more fearful in a crash. A good process accounts for this and also considers things like your level of trust and overconfidence, which can distort self-reported risk tolerance. Behavioral questions can add a lot of depth here.
Okay, beyond external help, what internal tools or mindset shifts can we cultivate?
Understanding bounded rationality is powerful. Recognize that seeking the absolute perfect optimal decision, being a maximizer, is often exhausting and leads to regret. Instead, aim to be a satisficer.
A satisficer.
Someone who aims for a good enough solution that meets their core criteria. Satisficers tend to make decisions more quickly and experience less regret. In the face of paralysis, good enough and done is usually far superior to perfect but never started.
Embrace good enough. I like that. What about that system 1 versus system 2 thinking? Fast brain versus slow brain.
Crucial concept. System 1 is our fast, intuitive, emotional, heuristic-driven thinking, where most biases originate. System 2 is our slow, effortful, logical, analytical thinking. The strategy is to use your slow, rational System 2 brain to create your financial plan. Maybe write it down in an investment policy statement. Then, when your fast emotional system 1 brain wants to panic sell or chase a hot tip, you refer back to the plan your rational self made.
You literally tell your emotional brain, nope, we already decided this when we were thinking clearly.
Exactly. It provides an anchor to your rational self. Another internal shift is to consciously reevaluate your personal financial beliefs. What messages about money did you grow up with? Are they serving you? Challenge spending norms, explore different philosophies, build healthier habits that align with your goals, not just inherited beliefs.
And practically speaking, maybe cut back on the noise.
Absolutely. Limit social media time, especially feeds that trigger FOMO or showcase unrealistic financial lifestyles. Unfollow the finfluencers pushing dubious schemes. Curating your information environment is a powerful act of mental hygiene.
Writing that investment policy statement, IPS you mentioned, that seems like a really concrete way to use System 2.
It really is. Documenting your goals, strategy, concerns, chosen approach, it forces clarity and creates accountability. When doubt creeps in, you can revisit your documented rationale. And one last mindset shift, perhaps counterintuitive. Learn to attribute some success to luck, not just skill. While your choices matter, markets involve randomness. Acknowledging the role of luck, especially when things go well, can paradoxically help mitigate regret when things inevitably go wrong. It reduces the burden of feeling personally responsible for every market fluctuation, allowing you to learn and move forward without being paralyzed by self-blame. #outro.
Wow. We have covered a lot of ground today. A really deep dive into analysis paralysis, the paradox of choice, and all those behavioral biases silently shaping our financial lives.
From the JAM study teaching us about choice overload to understanding why we irrationally hold on to losing stocks or overestimate our own genius, it's clear our psychology is profoundly intertwined with our portfolio performance.
But here's what feels really empowering about this conversation. Just understanding these biases, just being aware of them, that's the absolutely crucial first step.
It really is. You now have a toolkit, not just financial strategies, but psychological insights to help you navigate the noise, the complexity, the emotional roller coaster of investing.
Think back to Maya. Her story wasn't just about the cost of delay. It's a reminder that inaction, driven by fear and overwhelm, is often the biggest risk we face.
Definitely. The costliest mistake is frequently the one you didn't make, the investment you didn't start, the plan you didn't follow.
So as you listen to this, what really stood out to you? We really encourage you to take a moment, reflect on your own experiences with financial decisions. Where have you felt stuck? Where might these biases be playing a role?
And remember, the journey to financial well-being isn't about achieving perfection overnight. It's about making steady progress. Be kind to yourself. Be patient with the learning process. Keep moving forward, one informed, conscious decision at a time.
Absolutely. Progress, not perfection.
As we wrap up, here's a final thought to chew on. In this age of seemingly infinite information, endless data streams, and countless choices, what is the single most valuable piece of information you could possibly possess?
Is it knowing exactly what the market will do next week? Finding that one perfect stock?
Or is it truly knowing yourself? Understanding your own psychological triggers, your biases, how you personally react to uncertainty and risk. Perhaps self-knowledge is the ultimate financial edge.
Something to definitely ponder. We sincerely hope this deep dive has been educational, maybe a bit inspiring, and ultimately empowering for you.
We hope it helps you break free from any paralysis you might be feeling.
If you found value in our conversation today, we'd love it if you'd help the Psychology of Money podcast grow. Share this deep dive with a friend or family member who might benefit.
Leave us a review on your podcast platform or send us your thoughts and questions. Your engagement really does help us reach more people and keep having these important conversations.
Thank you so much for listening, for spending this time with us, and for making us a part of your journey towards greater financial wisdom.